Good morning, everybody. My name is Martin Rotheram from NEUBERGR-BERMAN, here to talk to you about the Global Senior Floating Rate Income Fund. Very pleased to be here in Israel. It's the fourth time I visited over the last 18 months. We've had kind of great support for loans. I'd especially like to thank you for making me feel extra welcome by making it rain today. So it certainly makes me feel at home, normally being based in London. So thank you very much. That is above and beyond the call of duty. So thank you. As I said, I'm going to talk to you about the senior floating rate loan asset class, something that you may not be familiar with. So I just wanted to kind of dive right in and just talk about initially how a company may typically may raise capital, may raise finance. I think probably two of these you may be familiar with, one not so, and that's my asset class. I've used the example here of MGM Grand, who you'll probably know well as the entertainment hospitality company, owned the Bellagio.
2 minutes about your company.
Oh, sorry. NEUBERGR-BERMAN is a global asset management business. We have been managing money for over 70 years, primarily based in the US, with offices globally through Europe and into Asia as well. We manage around $250 billion we have under management, and think of that as primarily being half in equities and half in fixed income. We have a small alternatives business as well, but if you think of that split, that's a pretty good guide. I'm part of the non-investment grade team. We manage 40 billion of loan and high yield bond assets, again primarily based in Chicago, but certainly from my perspective, I've been involved in this asset class for over 10 years now, and as have my co-PMs, we generally have 10 to 20 years of investment experience. We're happy to share more on the firm after the presentation. My colleague Imen's at the back as well, who can give you more detail. Okay. So back to floating rate loans, and MGM Grand, as I said, you probably know well as a company, sources its financing in a number of ways. First of all, the traditional equity markets. It's listed on the New York Stock Exchange. We're all familiar with the equity as an asset class. Similarly, it raises debt on the high yield bond markets. Again, an asset class that's probably more familiar to you, far easier to research, and certainly well known to investors in the non-investment grade space. But finally, and where I come in, I guess, is the loan asset class. So at the bottom of the table there, senior floating rate loans, another method by which companies can raise debt to finance corporate activity. And if we dig down deeper into what a loan actually is, and we start with what are senior floating rate loans? The first thing to do is just get behind that name. Loans have a variety of different monikers, which I know it's all confusing, but you will hear senior floating rate loans referred to as leveraged loans, sponsor-backed loans, bank loans, syndicated loans. It's all the same thing. Alongside high yield bonds, it's a loan made to a non-investment grade company to finance some type of corporate activity. Generally a merger or acquisition. It could be a dividend payment, a certain capital expenditure project they want to finance. I'll compare, through this presentation, I'll compare loans a lot to the high yield bond market because the method of operation is very similar, but we'll also touch on the differences and key differences from an investor perspective between the two asset classes. So loans have a primary and secondary market. I can buy new issue. I can trade these loans as well. We'll spend more detail or have more detail on those later. But as you can see, the start point is the loans are put together by arranging banks. So the US investment banks, the larger global players that you'll be familiar with. Myself and my team will go along to presentations and hear the pitches from MGM, from Dell, from the larger cable businesses in Europe, NEUBERGR, Ziggo in the Netherlands, for example, who all issue paper in the loan market. They all tell me how great their company is, which is a very consistent feature in all of these presentations. And I've got to work out with my team in doing the credit analysis whether I want to invest in these companies. If I do like the company, and I obviously fall into this asset manager bracket here, but along with other different lenders, a syndicate of lenders, I would invest in NGM in this example. And for my recompense, if you like, recompense for the risk, I am paid a rate of interest, a floating rate of interest. Again, we'll dig more into that later. But that's just the general overview of how that works. But before we move on into some more of the specifics, just wanted to refresh on the market size. Now, it's a sizable market. It's been around for about 20 years, but as you can see from this chart, really over the last 10 to 11 years, since 05, 06, is when it has really kind of escalated and taken off. But to be clear, it's an accepted form of financing for non-investment grade companies. It's not just a short-term opportunity or a short-term way in which they finance themselves. We've seen demand steadily increase over the years, and at $850 billion in the US, and 100 billion euros in Europe, I certainly see it as sizable. That covers about 1,100 different issuers, 900 in the US, 200 over here. So let's look at some of the key, I suppose, benefits of the asset class, or where it differentiates itself from high yield. And to my mind, there's two unique features. One is loans are senior secured. The second is they are floating rate. So on that first point, being senior secured, being top of the capital structure. When I invest in NGM or in Dell, we have legal charges over all the assets of the business. That goes from land and buildings, through plant and machinery, debtor books, and importantly, cash. Now, what that means is, and this is a point where I don't want to get or spend too long on, that because you have that security, in the event of default, and generally defaults in the asset class have been very similar in loans and high yield, around the 3% level. It makes sense from that first slide, we're looking at the same issuer. Where the difference is in recovery levels. Because we have security, historically, recovery levels on loans have been 75 cents in the dollar. In high yield bonds, where you're unsecured and lower down the capital structure, in the mid-30s. The reason I say I don't want to get bogged down with that, because obviously defaults are what derail these type of strategies. I'm first and foremost paid to make sure that we avoid defaults, and security is by definition backup. But it does give protection for the asset class, and there's a couple more of compelling slides later which I'll show you, which just kind of back up that story. But to be clear, with that security point, I've just realised I said I won't spend too long on it, and I keep talking about it. But with regards to that security point, security gives control. So where in the limited restructurings we've had to work through at Neuberger historically, what it means is because you have charges over the assets, that you have the top seat at the table. You can dictate how any restructured balance sheet may look. There's never been an instance where we physically had to sell assets to repay debt. But just bear that in mind, security gives us protection. The second unique feature is we are floating rate. So the interest that the company pays me, which I distribute out to investors as income, is a combination of LIBOR, so a floating base rate, and a credit coupon. I'll start with that second point. It's classed on this diagram as the additional yield, so the number we see here. And generally, if I say that the majority of the market that I invest in is rated BB or single B, and the coupon that I get paid reflects the underlying risk of that borrower. So if we take, I suppose, a simplistic example, a great BB credit will pay 2.5% over LIBOR, a weaker single B, 5.5% over. That coupon is fixed for the life of the facility, of the loan. In terms of the LIBOR component on the left-hand side there, you'll see it mentions a floor. I'll come back to that, but just think of pure LIBOR to start with. Now, if I'm lending to a US company, 3-month LIBOR is currently 61, 62 basis points. LIBOR is reset on these loans every 90 days. So from a duration perspective, think of this as a very short, low duration product. Worst case is, we set LIBOR today at 60 basis points and LIBOR rises tomorrow. You've got 89 days, wait until it catches up. But short duration from that perspective. So certainly in a period of rising rates, then as LIBOR increases, the interest that the company has to pay increases, my income increases, and what I can distribute should increase as well. The one quirk in that feature is the LIBOR floor. Now, since we came out of the recession in the US, or post-crisis call it, on the majority of the deals that we've seen, we've had LIBOR floors in the documentation. And that was because LIBORs were at such low levels coming out of the crisis, and we as investors wanted a certain total return on our investment, that whilst companies weren't willing to give it on this middle box, so give a higher coupon, we came to a compromise with that LIBOR component. Now, LIBOR floors on portfolios are generally around the 1% level. The reason I talk about this is that obviously when LIBOR rates are low, it's a good income enhancer. When rates start to rise, then we have to wait until LIBOR breaks through the floor before the income that I generate increases so that I can distribute it. So at the moment, we're probably about 40 basis points shy of those floors, so we're going to see at least 2 rate rises before it breaks through the floors and distributions increase. So I just wanted to be clear on that point. And then finally on this slide, just the additional discount in the blue box there. 2 things to say here, and as I mentioned at the start, I can access the loan market through the primary and secondary markets. Now, when I'm buying MGM paper or Dell paper, for example, in the primary market, that par paper is normally offered to me at $99, $99.50. So an upfront fee, if you will, for investing in the transaction at that time. So that's part of the discount. Additionally, we have active secondary markets. Generally, if there's 10 to 12 primary or new issuer ranges for these loans, they all have secondary desks. So when those loans are what we call free to trade, once that new issue is allocated, investors can buy and sell these loans. Now, in times of volatility, and I'll tell you later that loans are a relatively stable asset class, but they are a risk asset class. They do evidence volatility. The loan market may trade off. And if there may be the ability for me to pick up a loan at, say, 97 rather than par, hence the 3% discount. So I guess this slide really just refreshes on what we've talked about so far, and it's relatively small, but I'll just run through it very quickly. But one thing I want to raise now, and one question you may have is, well, that's fine. I understand those 2 key features of the asset class, but bearing in mind a loan is floating rate, why on earth would a CFO have a loan in his capital structure if rates are going to rise? His cost of financing is going to increase. A key feature of the asset class for the CFO, and one that isn't on here, is that loans are prepayable at par at any time. So think of the benefit to the CFO there. He's made an acquisition. He's hoping to generate economies of scale, synergies from the integrating of 2 companies, generate increased profits and excess cash. He will want to use that to pay down his debt. The ability to do that at par without penalty, as opposed to a high yield bond where there may be more onerous call protections, is invaluable to him. So don't underestimate that feature. And through rate cycles, we've seen demand for loans be pretty consistent. So don't think that as rates start to rise, the supply of new issue is suddenly going to drop off. It's certainly a feature we've not seen historically, but I just bear that point in mind. So really, just to refresh what we've talked about so far, loans are floating rate as opposed to fixed rate for bonds, very low duration because that LIBOR is resetting every 90 days. We are secured, high seniority, which means that in the event of default, which I'm trying to avoid, we have good, high recovery rates for the asset class, certainly compared to high yield bonds there. And in terms of liquidity, I can buy and sell these asset classes on the open market as I could do for a high yield bond. One point I will touch on now, just on liquidity, is that loans are over-the-counter trades. They don't settle on an electronic exchange, which probably goes some way to explain why it's a bit harder to research and reference the asset class. Loans will generally settle T+7 in the US and T+10 in Europe, compared that to T+2 and T+3 for high yield bonds. Loans sometimes get a bad press about liquidity, and the reason is that settlement period. In terms of actually being able to trade the underlying loans, as I mentioned earlier, 10 to 12 market makers, bid-offer spreads are generally in the 25 to 50 basis point range, so very similar to high yield. But just bearing that in mind when you're looking, if you're researching the asset class, the fact that it's not available in a UCITS format.
Excuse me.
Yep.
With regards, if you go back, the
Yep.
average duration
Yep.
with regards to maturity, forget interest rate for a moment. What's the average duration, the maturity-wise?
So in terms of the legal life of loans,
Yep.
is in the 5 to 7 year range. Now, in all the years I've been doing this, a loan has never gone to its full maturity.
Fair enough, but it's
Yeah.
5 to 7 years.
The average life in reality is normally 3 to 4. Because the CFO will look to pay down debt to get to a refinanceable stage. And if I look in my index, there's been, I've got issuers that come in for one specific event, pay down debt and migrate back up to investment grade, or will be serial acquirers, make an acquisition, lever up, repay, and repeat the same process. So just on to some of the benefits and just look at some of the income slides here of the asset class. Obviously, everything I say comes from the benefit of a loan manager. So this is my view. So obviously, I think loans are good value. How I gauge that and judge that is again against high yield bonds. And I think, our view is, I think data will back this up historically, that if you're looking at the differential in yields between high yield bonds and loans, it should be about 200 basis points, i.e. that's what you should get paid more for being lower down the capital structure in high yield bonds. You're unsecured, you're taking more credit risk. At the moment, we've got about 170 basis point differential in US loans versus high yield, and about 70 between European high yield and loans. One point I would make about the asset classes as well is that hot topics at the moment, commodity linked issuers. Well, in US high yield, about 15% of the index is in kind of oil and gas, energy, etc. In loans, we have about 6%. So a lower proportion of those more problematic sectors finds itself in the loan asset class. And how loans should operate through a rising rate or different fluctuating rate environments is kind of evidenced here really. So primarily on the left-hand side we have loans, on the right-hand side just fixed rate investments. And certainly here on loans our principal amount through the varying rate cycles remains pretty constant, with the variance being that income component at the top. So as we talked about earlier, as base rates increase, so should the income being generated. Whilst on the right-hand side, as rates increase in more fixed rate investments, we tend to see the price of the underlying asset reduce. We see more kind of volatility in those assets, which is backed up a little bit on this slide and the next. This takes us back to almost 3 years ago now, when Bernanke first floated the idea of potential tapering of QE and the reaction the markets had then. And what we've plotted here, you've got the loan asset class At the top there, the grey line, we've got US high yield, which is the yellow kind of line here in US investment grade. Not quite sure what colour that is, but call it beige. At the bottom there, as we can see, you know, what we normally say with loans and volatility is because we are top of the capital structure, that we should evidence half the volatility of high yield and a third to a quarter of equities. And we see certainly during you know, May, June of this period, you know, loans were very resilient. So, you know, kind of flat along the top as we saw the trade-off in these fixed rate assets. But I mean, that's 3 years ago. To bring it more up to date, you know, the first quarter of this year has been very interesting. Certainly, you know, January, February was very negative in terms of sentiment. March, we've seen a rebound, and into April as well. We'll see, you know, how long that continues to run. But certainly feeling more positive standing here now than I was 6 weeks ago. That's for sure. But again, you know, back to the loan asset class and how it should behave. Not saying that everything's been sweetness and light for us, but a more consistent performance. And this plots loans in the US and Europe against high yield and equities. So, you know, if we take on the US line here, you know, kind of mid-Feb, down 1.5%, 2%. You know, high yield down just over 4%, pushing 5%. Equities down about 11%. You know, that's a reasonable relationship there. Because of that, and because of where we are, and because of what we pay relative to other asset classes, you know, we are going to be consistent. You know, we're not going to capture this kind of upside that high yield has got either. So it's a bit kind of steady in the middle, but just from a risk-reward, you know, kind of balance, but also bringing limited volatility. You know, we think that's a good, you know, feature of the asset class. And this is someone said to me once that this is the most boring slide they'd ever seen in a presentation. And that's a good thing for this asset class. What it shows us is, excuse me, it's a Moody's study of preservation of capital in the loan market in the US. And basically, the difference between the top of the blue bar and 100% is what was lost from the loan market each year, what was written off. Tells us that over that period, as we can see, you know, 98.5% of capital was retained. And even in, you know, the darker days of 2009, double-digit default rates, 93% of capital was preserved in the asset class. There's no sinister reason why 2015 has missed off. We just got the data for that last week. That's a very similar column to what you see in 2014. But I think it's quite a compelling slide, maybe surprising, you know, bearing in mind we're looking at a non-investment grade asset class. And then, you know, just finally, we've always said when we're talking about the loan asset class, and this may be slightly, some of these numbers are a bit small and words are a bit small, that it's not loans or you know, and nothing else. I think that loans have a place in a balanced fixed income portfolio. We've talked about, you know, the benefits of being senior secured, top of the capital structure. It is a risk asset class. Never kind of forget that. But volatility compared to other risk asset classes should be more limited. We offer a shorter duration, and for the risk being undertaken, I think the returns, in my opinion, are relatively compelling. You know, from a correlation perspective, just on the right-hand side, as I said, you know, most correlated to high yield. So back to this risk asset point that when high yield sells off, so will we, but hopefully to a more limited extent. And that are all the slides I had to show you. So I don't know if there's time for questions, if you have questions or not. Thank you.